Today is part 2 of 2 of my video on SPACs. We're going to talk about units, shares, and warrants coming up. Welcome back to the channel, guys. Again, my name is Sean. If you're new here, we talk about investing, personal finance topics, documenting my journey to financial freedom. If you're interested in following along, please consider hitting that subscribe button. But another kind of really detailed technical video going on today, so I'm gonna just jump right into it. If you guys haven't seen the other video I did on SPACs, you might want to jump into that one because this is sort of a build off of that. We're going to talk about I introduced a timeline in that video. We're going to talk about a specific part of that timeline, and we'll really get into it with the warrants here. One last plug I also have to put out there is to go check out Donnie Nguyen's video on this. He has a channel called Wolves of Investing, and I got a lot of information for this video from his channel. So please go check that out. I'll leave a link in the description. I'm going to start with just explaining what units are. And when I first started learning about SPACs, I kind of confused units with stocks and shares and stuff, but units are a little bit different. So what are they? They are the initial unit or thing that you trade for a SPAC. We'll call it a product, right? Units are actually made up of a share plus a fraction of a warrant. And that fraction is stipulated in the S1 filing, which we talked about in the last video. So a company IPOs, they spell out all this stuff in their filing, and every unit is made up of a share plus maybe half of a warrant or a third of a warrant, or sometimes it's a full warrant. So we'll talk about what warrants get you in a second here. Now, it's important to also know a little bit of fine print here that a brokerage will charge you a fee to split a unit up into those two components. So the point of buying a unit is later you're going to split them up into warrants and shares. A brokerage like E-Trade is going to charge you $38 to do that in something called a voluntary action. I've tried to find the fee for that, and I know that Questrade will do different types of splits, but I wasn't able to figure out exactly what Questrade charges. But if I do, I'll put it in the description. Now, by the way, you will need to pay attention to that little fraction if you're going to buy units, because later when you go to do what's exercising the warrant part of that equation, you are going to need to have a full warrant in order to get a share and be able to redeem that. So if you're buying units where they give you a share plus half a warrant, that means you're going to have to get 2 units, so then you'll have 2 shares plus a full warrant that you can also trade for a share a little bit later on. So I hope that makes sense. So typically 52 days after an IPO, like a SPAC IPOs, they will split their units up into those shares and their units. So that's where we are here on the timeline. So now you'll actually have 3 things on the exchange. You might have units, shares, and warrants all being able to be traded at the same time. Now, when they start out, a unit will equal what is stipulated in the S1, like a share plus the fraction of the warrant. And if everything moves together, then there really isn't much of an opportunity. But where the opportunities arise is when some of these components start trading, and that balance of the equation is moved a little bit. So if they don't move perfectly together, you can find some opportunities there to get you more exposure to this company at a little bit of a cheaper price. So we're going to jump into some examples right now just to show you what I mean. So here is an example of AJAX, which is the company we used as an example in the other video. So the unit price as of the recording of this video of AJAX is 13.49. And we know it's made up of 1 share, which is currently trading at $3.60. It's got a 1-to-1 ratio of shares to warrants, and the warrant price is $12.62. So when you do a little bit of math there, you can see that the unit price is actually lower than buying these components separately. So this is an example where you might think about buying the units, and you might say, well, it's cheaper for me to get the units as a package and not buy these components separately. Now let's just do another example for Switchback Energy. The unit price for Switchback right now, $45.81. The share price is $39.62, and the ratio is 1/3, so every unit has 1/3 of a warrant. So you go 1/3 of the warrant price, which is $17.99, gives you $45.58, which is pretty much the same as $45.81. This is about as close as an example as I could find today. So in a case like this, you might look at it and say, well, I'd rather get the shares and warrants separately. It gives me a little bit more flexibility and I don't have to pay a fee or call my broker to get these separated. So here's an example of where you kind of have the choice. Okay, so now we understand a little bit about units. Let's get to the second part of this equation and talk about shares. Now, shares are pretty straightforward. We're probably most familiar with these. With SPACs, shares do have a little bit of a guarantee built into them. So typically, these start at $10 when a SPAC IPOs. This price is of course stipulated in the S1, and if no merger is found in the next 2 to 3 years, the money will go back to the investors plus any interest and maybe minus some management fees. So there's a little bit of protection there. If you went and invested at $10.50, well, you've only really risked 50 cents. You still have, you know you're going to get that $10 back should something happen and no merger is reached. So that's kind of a nice thing about shares. You don't get that with warrants. So your goal here is to buy these as close to $10 as you can. And sometimes they even go below $10 and become a really good buy. Also, it's important to note that if you're into trading options, that's not something I've covered on this channel yet. But if you're into options, you can only sell calls on shares. You can't sell calls on warrants. Okay, so now that I've mentioned warrants a bunch of times, let's get to the warrants part of the equation and what you need to know about warrants. So what a warrant is that it gives the holder a right to buy a specific stock at a specific price after it becomes what's called exercisable. And that exercising date is stipulated in the S1, but it's usually 30 days after a merger with a company. So remember we said that the point of a SPAC is to do some kind of business combination with another company. So 30 days after that, you are able to exercise these warrants. And you need to know the timing because that affects the share price too. We'll get into that in a bit. The S1 filing will also give you the relationship of shares to warrants. So in the case of AJAX, when it was 1-to-1, one warrant will get you 1 share. In the switchback, for example, it was a third. So you needed 3 units to have a full warrant and trade that for 1 share. That fraction becomes important when we start doing some of these equations that we will do in a minute here. Now it's important to note that warrants trade under a slightly different symbol. So if you take SBE, which is switchback, that's SBE is the ticker for the share. SBE-wt is the warrant. So it's important to note that it comes packaged with the unit, but that's how you find them separately on the exchange, which is 52 days after the SPAC IPOs, and they trade separately. Now, as I mentioned, warrants don't have that price protection that shares do, so they are inherently a little bit riskier, and that's why they usually trade at a lower dollar value because investors are accounting for that $11.50 that you have to pay to exercise them. Plus, they're a little bit riskier, so not as desirable maybe as the shares, but that really depends on the timing. Warrants will usually trade at a premium at first, and by a premium I mean the warrant price plus the $11.50 will be higher than the share, but over some time, they will start to increase in value and will become perhaps the better deal. That's kind of what you have to decide when you invest in them. By the way, the exercising price, that $11.50, is also in the S1. The price of the warrant is also in the S1 as well, so it's important to read the S1 when you're dealing with units, shares, and warrants. Now remember that warrants also have a 5-year expiry, which means that the warrants will expire worthless after 5 years. You have to redeem them by 5 years, but also the company will almost always put in an early redemption clause. And what that is for most of these SPACs that we'll talk about today is a pretty standard one, which is should the share price trade above $18 for 20 of 30 consecutive trading days, then the company will issue a note out to everybody and say, hey, it's time to come and redeem your warrants. Now, there are 2 types of redemption that could happen. One is called a cash redemption, which is where you're paying the company that $11.50 with the warrants and you get like a 1-to-1 ratio back. So for every warrant, you get 1 back. But the company also has this other thing called a cashless redemption. It's another option that they can use where instead of you paying the $11.50, they say, don't worry about the $11.50 and we'll give you back a fraction of a share instead. So let me say that one more time. So instead of paying a full warrant plus the $11.50, they're going to say, forget about the $11.50 and we'll take a fraction off of that warrant. And that's what you get back. And the point of this is while the company won't raise money, they won't dilute the pool of shares that they have as much doing it this way. So it gives the company a little bit of an option there. So we've talked about units, we've talked about shares, we've talked about warrants. Why would you ever want to trade warrants? It just sounds complicated, right? Well, there are some scenarios where if you understand this and you don't mind putting in the time to watch this stuff, that it can be profitable. The real reason that you would want to buy a warrant is that it gives you some exposure to this stock at a little bit of a lower price, but you do have to have a game plan in mind to make this make sense. So again, you're looking for the components of the unit not being quite in sync. But instead of me trying to list all these scenarios out, I'm just going to do some examples for you guys so that you're able to see what I'm saying. So let's jump to it. Here's the first example. Okay, so let's use Switchback again. So their share price is $39.62 right now, okay? And the warrant price is $17.91, and the warrant price plus the exercise price is $11.50. So if you're able to get a full warrant, you can actually get a share theoretically for $29.41. So here's a scenario where you might actually prefer to get the warrants because you can actually save $10, pretty much $10 per share doing it this way. So you might say, well, that's a great deal. Why doesn't everybody do this? Well, it's not always the case, and we'll get to some other examples. It's not always the case where there's this discrepancy. Right now, because of the timing, this is a good opportunity for using warrants on this particular SPAC. But other people might value the security of the share rather than the risk that comes with the warrant. Now let's go back to Ajax as the example. So here we go. They are $12.62 for the share price. The warrant price plus the exercising price is $15.10. So in this scenario, you would probably want to go with the share. It's got the built-in protection, and it's cheaper than getting the warrant and the exercise price, right? The other question you ask yourself is, would you ever be in a scenario when the warrant price is more than the share that you would want to get the warrant? Well, actually, yeah. If you think that this share is going to do well, that is when you want to get the warrant, or you might want to investigate the warrant a little bit, because it has that increased exposure. If the share price goes up significantly, you're actually getting more of an upside with this than you would with the share price. So let me give you an example of that, because this is where it starts to get confusing for me, and that's when I had to really slow down and do this. So let's take that same example. Now, what if the price of Ajax doubled? Okay, here's what we would get. So the price doubles to $25.24. So that's a 100% increase if you bought one share. Now, what if you bought one warrant? Well, to figure that out, you take the share price minus the $11.50 exercise price. That gives you $13.74. So now your warrant's worth $13.74. You had paid $3.60 for it. So $13.74 minus $3.60 over $3.60 gives you an increase of 282%. So that's a lot more than the share, even though the share went up the same amount. Assuming it hits its intrinsic value, the warrant is giving you that much more upside. So that's an example of where even if the warrant's initially higher than the share, you might be up for trying to get that warrant if you really believe the price is going to go up. So normally I would stop there with the examples, but the nerd in me really wants to know, well, what's the break-even price? Like, what am I thinking Ajax is going to go to for me to jump on the warrants instead of the shares? Now, this might be a little bit too much math, so just bear with me. But if you want to know what that, I call the break-even price, I guess, would be, here's how you would do it. So you're trying to solve for an unknown price. That's like maybe your break-even price minus the share price, which you already know, over the original share price, because you're trying to figure out what percentage will these end up being the same. On the right hand side of the equation, you have what you know, which is your exercise price and the current warrant price, and you would set it up in this equation, which is just like what we did in the last example. Now, nothing turns me on more than the three words solve for X. I mean, this is what the equation looks like. You solve for X, there's a few steps involved in that, but essentially X is going to be equal to $145.13 over 902, which gives you the break-even price of $16.09. So that is what you would anticipate the share price to go to for you to break even. If you think it's going to go above that, you might say to yourself, well, I should get the warrants. But if you think it's going to stay below, then you might be better off with the shares. It really depends on what you think the share price is going to do, and that's why these are a little more speculative. SPACs in general are more speculative, but these warrants are especially. You really kind of need to know. You want to know if the price is going to go up. You want to know if the price is going to hit that $18 threshold and force you to redeem the warrants, or if it's going to stay somewhere in between and get up there a little bit later, but before the 5 years that it takes for the warrants to expire. So there's all these different factors and boundaries you kind of have to keep in mind when you're dealing with warrants, because they have all these little rules with them. Let me just get into that and touch a little bit on the timing of when you want to sell the warrants. So as you get closer to the exercise date, the discount that you got the warrants on, or sometimes what people call the arbitrage, kind of starts to even out with the share price. They sort of start to even because the people are anticipating that at the exercise date, people are going to be redeeming their shares and kind of diluting the shares a bit. So it kind of brings the share price down while bringing the warrant price up. So it's important to know that that happens as you close in on that exercise date, which is 30 days after the business combination. But you may also want to buy warrants, as we just discussed in the last example, if even if they're more expensive than the shares, if you believe over time that the price is really going to go up high in the long term. So why would you want to buy warrants? Here's a quick summary of what we just talked about. You may like warrants for the short term because it gives you exposure to that stock at a cheaper price. If you're like not 100% sure you want to put in a ton of money, you may want to just get the warrants just in case something happens. You may feel safer to do it that way, but it still gives you exposure at a cheaper price. You may also like them for the long term, like we just said, 3 to 4 years, if you think that is when the price is going to go up, before you have to redeem them on early redemption clauses or the end of the 5 years. So you'd get warrants if you think that the share price is going to increase higher than what your cost basis is in the long term. Now note that the further you go out from the floor price of $10, the better value that warrants become. That's assuming that the price increases. You may also like shares in general if you trade options, or if you want to get that built-in $10 price protection like we discussed. Finally, let's talk about some risks of warrants. Remember that this is why they are cheaper than shares, so it's important that you understand them. We'll go over them right now really quickly. The first is that they're more volatile. So these tend to swing a little bit more than shares, so there's some inherent risk in there. The second is that what if the stock price never goes up or that it crashes? Well, your exposure to warrants, you could end up losing that money that you have invested in the warrants, and often the SPAC stock dips after a merger. So if you're holding the warrants, your warrants will go down in value as well. So there's that potential for increased reward, but also you could lose a greater percentage of your investment too. So it's important to know that. The third is that there's no price protection built in. That $10 floor that you get with shares doesn't exist with warrants. So important that you know that as well. The fourth is, what if the price drops? So what if warrants are trading really high and the price starts to drop before the exercisable date? So in that scenario, you got your warrants up really high. Remember what we talked about is that at that exercise date, there's equilibrium reach. So what if the opposite of what we had just said happens, and what'll happen is your share price will start to go up, but your warrants will start to go down. So it's important to recognize when you're in that situation as well. And finally, to remember that warrants expire worthless if not redeemed into that 5 years, whereas shares you can hold on for however long the company exists for. So those mechanics, those little dates, the important little timers that start for certain periods, 30 days after the merger to exercise your warrants, and then the early redeemable clause, and then the 5-year expiry. You have to keep all that in mind when you're dealing with warrants. So that's what makes them a little bit trickier than common shares. So awesome. Well, I hope you guys have learned something here with warrants. Actually, something I should have said off the top is that I don't actually own any warrants. I literally just felt I understood them 5 minutes before I hit record on this camera to film this video. So I'm just sharing what I've learned. If someone out there is an expert on these and wants to add something, please put it in the comments below. That would be much appreciated. But just wanted to say that I'm still kind of getting used to these. I find them as being a little bit riskier just because they need some understanding a little bit more than maybe a traditional stock that I'm used to. So anyway, until next time, have a great week, guys. I hope you learned something here. I hope there was some value. Have a great week. Spread the wealth, and I'll see you in the next one. Bye.